Bitcoin. A word that evokes euphoria for some and dread for others. After a meteoric rise from pennies to over $100,000, the world's first cryptocurrency became a symbol of rebellion and hope for a decentralized future. But beneath the hype, critics warn that Bitcoin could one day be worth nothing. How could a trillion-dollar asset vanish? Stay tuned as we uncover the reasons experts say Bitcoin's value may ultimately plunge to zero. Bitcoin's story starts in 2009, when an anonymous programmer published a white paper describing a peer-to-peer digital cash system. In the beginning, only a handful of enthusiasts took notice. Someone famously bought 2 pizzas for 10,000 Bitcoin. By 2021, however, 1 Bitcoin was worth more than a luxury car. Economist Eswar Prasad points out that Bitcoin has no intrinsic value and is not backed by anything. Its price depends on collective belief. As long as investors find a bigger fool willing to pay more, the bubble inflates. But when faith wanes, there is nothing to stop a freefall. History shows wild swings. After peaking above $65,000 in late 2021, Bitcoin crashed to $20,000 a year and a half later. These boom-bust cycles illustrate the fragile psychology underpinning the market. Unlike stocks or bonds, Bitcoin operates in legal gray areas. Investopedia warns that the regulatory status is still unclear in many jurisdictions, and that a sudden crackdown could make it difficult to sell Bitcoin or cause a market-wide price drop. When China banned crypto trading and mining in 2021, Bitcoin's price plunged. The United States and Europe are debating strict rules for crypto exchanges, while other countries have announced outright bans. If a major economy prohibits exchanges or prevents banks from processing crypto payments, liquidity could disappear overnight. Without regulated on-ramps or off-ramps, Bitcoin could become a stranded asset. For many people, Bitcoin conjures images of the dark web and ransomware. In a February 2024 blog post, European central bank economists argued that Bitcoin has failed to fulfill its promise as a decentralized currency, and that its fair value is still zero. They said transactions are inconvenient, slow, and costly, and that Bitcoin is hardly used for payments outside of criminal activities. Investopedia echoes this, listing money laundering and illicit purchases among the major disadvantages of cryptocurrencies. Such associations erode trust and give regulators more reasons to crack down. Mining Bitcoin isn't just abstract mathematics, it consumes real energy. The Brookings Institution notes that the network uses as much electricity as entire countries like Argentina or Norway and produces mountains of electronic waste. A United Nations University study warns that global Bitcoin mining is highly dependent on fossil fuels and has worrying impacts on water and land. Another report from the American Geophysical Union says China and the United States have the largest Bitcoin mining footprints and that the impacts on land and water are very worrying. As climate concerns intensify, governments may tax or restrict high-energy cryptocurrencies. Should mining become unprofitable, the network's security could unravel. Bitcoin's price is set on exchanges that are lightly regulated, leaving it vulnerable to manipulation. An ECB blog summarized by GateLearn notes that in unregulated markets prices are constantly manipulated, there is no supervision and there is no fair value. Investopedia lists market manipulation as a significant risk. A handful of large holders, so-called whales, can move prices by dumping or hoarding coins. Without transparency or oversight, rumors and social media posts can spark panics. If investors realize the market isn't as free or fair as advertised, confidence could collapse. Bitcoin's longevity is hinged on a dedicated community. The DeVere Group notes that a cohort of hardcore believers who will never sell has buoyed the price. Yet former Citibank trader Gary Stevenson drew headlines when he said Bitcoin is definitely going to zero. As institutional investors move in and out based on macro conditions, the burden of price support falls on a shrinking group. Should their conviction falter, because of scandal, regulation, or simply a better alternative, the price could spiral downwards. Bitcoin's security relies on cryptographic algorithms. The Val-R blog explains that quantum computing algorithms like Shor's and Grover's could one day crack public key cryptography and hashing, meaning that digital signatures used by Bitcoin could be forged. Quantum computers capable of such attacks do not yet exist, but progress is accelerating. Researchers are developing post-quantum cryptography standards, and a draft Bitcoin improvement proposal suggests migrating coins to quantum-resistant wallets. The transition would require consensus and may involve contentious hard forks. If a state-level actor or hacker were to break Bitcoin's signatures before the network adapts, confidence could evaporate overnight. Will Bitcoin actually hit zero? No one can say for sure. Its passionate supporters argue that scarcity and network effects will keep value afloat, yet critics point to the absence of intrinsic value, the risk of harsh regulation, criminal association, environmental damage, market manipulation, and looming quantum threats. In the end, Bitcoin's future hinges not just on code, but on trust. Whether you're a believer or a skeptic, one thing is clear: understanding these risks is critical. Before you buy or hodl, ask yourself, what happens if the music stops?